Hi everyone, this is Jason Barack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. We last had him on in January of 2015. We like having him on every couple months for his views on the markets because they're very awesome. He has the popular website Investment Research Dynamics. He's a gold fund manager. He's a former bond trader on Wall Street, worked there at many different jobs, and he also has the Shadow of Truth podcast, which is gaining very quick popularity. Thank you for joining us again, Dave Kranzler.
Thanks for having me back, Jason. I always love being on this show.
And I always love having a discussion with you, Dave. I always learn a lot from them. So, you know so much about so many different markets, having traded in bonds and interest rates, and now you're in gold. Well, let's jump right in here. My first question has to do with interest rates in the bond market. I've had on a lot of guests, whether that's Mark Faber or Dr. Mark Faber or many other experts. In your opinion, do you think the Federal Reserve is trapped in terms of being able to raise interest rates?
Oh, I think there's no question about it. I mean, they're trapped in the sense that if they don't want to collapse the economy, they're not going to be able to raise interest rates. I was running some numbers the other day for my investor quarterly letter, and the government now spends 12% of its spending budget on just the cost of interest on Treasury debt. And these are all public numbers. You can get them on the Treasury website or the Federal Reserve website. So they're spending 12%, and this is at a time when the government debt's going up at $1 trillion a year. It's probably going to go up more this year, and interest rates are basically at historical lows. So if the Fed were to raise interest rates, it would increase just from increasing alone the cost of debt service up to the government of the Treasury market would create serious problems.
Yeah, Dave, a 1% rise, I think, right, in interest rates, which is, historically not really that much. That's not even mean reversion. I think a 1% rise would be $180 billion extra, right, for every 1% increase.
I haven't run those numbers, but yeah, I mean, the math's easy enough to run. If you want to talk about on a very long-term historical basis, average interest rates average more like 6%. We're basically at 0% on the short end, and the Treasury's done a lot to try and issue short, and obviously the Fed's been buying the longer end of the curve. So if the Fed were to raise interest rates, I mean, you'd probably start to see the U.S. government go insolvent pretty quickly unless the Fed rolled it out with more QE, because basically the QE was done to A, keep the banks from collapsing, and B, to help, to basically finance most of the government debt that's been issued since QE started. I forget what the number is. I think from like 2010 until QE sort of formally ended, I think the Fed ended up buying something like 2/3 of all new debt issued.
Yeah, and that's just the overt number that they've actually told us. I mean, after 2008, everything crashed. In 2009, Ron Paul was able to get that one-time partial audit of the Fed, and it was revealed that $16 trillion was given out. And I honestly don't think that's a real number. I think it's quite a lot higher than $16 trillion, but there's all these currency swaps, and you brought up a very valid point there about the interest rates and controlling the curve. It's not just the United States doing it. It's Europe, it's the United Kingdom, it's Japan. I mean, Japan's been doing this basically longer than anyone in the developed world. All these governments, Dave, they're all Keynesian central bankers running the monetary policy, and they all seem committed to financial repression, where they have no other solution to try and quote unquote fix the economy, with central planning, except to manipulate the interest rates lower and lower just to keep everything from collapsing immediately.
Right, and we're just talking about, what would happen to the cost of servicing the government debt if the Fed were to raise interest rates. I mean, if you look at the housing market, mortgage rates are basically, almost at all-time lows right now, and home sales aren't. I mean, existing home sales are about 50% of where they were at the peak of the market. And back then, when the market peaked back in 05, 06, long-term interest rates were over. Mortgage rates were over 6%. And now you can get a 0% down mortgage from the USDA if you live in what's defined as a rural area, which isn't really a rural area. You can get a 0% down, basically 3%, 3 to 4% mortgage, down to a 580 credit score. And I know the quoted rate on a 30-year mortgage is probably around 3.75% for good credit. And you're basically only putting 3% down because it would be a Fannie or Freddie conventional program. So imagine what would happen if Fed started jacking rates and all of a sudden cost of a mortgage went up to 5 or 6%. I mean, it would basically shut off the housing market.
Yeah, I think they're committed, the end game committed to manipulating interest rates as close to zero and holding them down there as long as possible just to keep this debt-based fiat currency and credit bubble scheme going with asset bubbles and stuff as long as possible. To provide a little anecdote, Dave, since I know you follow the housing market, my business partner, Mo DeWood, he rents in Fairfax County, which is one of the highest average median family income counties in the whole United States. And Fairfax County just sent him out a flyer. He posted a picture of this on his Twitter feed, and they sent him that he doesn't even need to come up with his own down payment now in order to buy a house, that they're willing to, with government programs and state subsidies and other things, they're willing to provide him, X amount of thousands of dollars so it's cheaper for him than once they provide him the subsidy to put the down payment down on a house to buy a house instead of rent. And what he told me is a lot of his friends that grew up around here, they're doing this. And this is, supposedly one of the richest counties in the United States in terms of average median family incomes, and they're doing this, housing subsidy scheme too now.
Who's sponsoring the program?
Offhand, I don't know. I'd have to send you the particulars. I could get Mo to send you a picture of it. We'll talk about this off. I didn't know we'd discuss this, so Mo has the picture of it. I'll have him send you the details later.
Sure.
But, this is the richest county, or one of the richest counties in the United States, and the Washington, D.C. metro area has three out of the 5 of them because of the big government bubble. And yet, I walk into the Sprint store here, for cell phones, and they're telling me, you don't have to pay any cash anymore to buy your phone. You could just pay for it on credit installments and all that, because people, I guess, can barely afford their rent because they're working 2 or 3 part-time jobs just to pay any bills and student loan debt and their rent and food and stuff, that, they can't pay an extra $500 for a new iPhone or a new Samsung phone.
Amazing.
Okay, so let's talk then about your article then about the housing market. You're talking about the lumber market. How does that play into the housing market then?
Well, obviously, new home builders need lumber to build new homes. And so in cycles when there's a lot of new homes being built, the price of lumber is going to go higher. Well, currently the price of lumber it essentially looks to be in a free fall. I mean, it was down today, I believe it was down 6% today. And I mean, it's let me just get a calculation here from when it peaked. It hit a high of 420. It's measured in board feet, and so it hit a high of a lumber contract hit a high of 420 at the beginning of 2013, and now it's down to 250. So it's down $170 in that time, and most of that fall has occurred since it started in late 2014. And my view is that the housing market essentially, the home builders, like the existing home sales, have gotten up to about 50% of their peak volume before the bubble burst. The new home builders have only gotten back to about a third of what their peak volume was. And I think what's happening is, I mean, the bulk of those existing home sales, not necessarily the bulk of it, but a high percentage of that existing home sales was obviously from big investment funds who were buying up massive blocks of homes, especially from Fannie and Freddie. And most people don't know this, but the government made available to the big funds who bid on blocks of homes off of the GSEs, they made available 0% financing. So BlackRock basically, any of the portfolios of homes that they bought from Freddie and Fannie, they financed it with 0% loans from the taxpayer. So at any rate, you had basically sort of an echo bubble that occurred in the housing market, and a big part of what drove volume was investment buyers. And I think what's happening right now is you're seeing a lot of flippers go and buy homes. And the reason why we know this is the case is because the first-time home buyer historically is 40% of total sales volume in the housing market. It's currently under 30%, and it's been stuck under 30% for about the last year and a half. It actually got as high as 50 to 55% at one point. So the first-time home buyer is basically out of the market for the most part. And if the first-time buyer isn't buying, then it also means that move-up buyers can't buy because they rely on the first-time buyer to buy their home from them so that they can then take the proceeds from their home sales and leverage it into a better home or a bigger home. So in between those two components, the first-time buyer and the move-up buyer, you're talking about 75% of the historical market. Now, interestingly, everyone's reading about bidding wars and all this other stuff in some parts of the country, and I think a lot of that has to do with flippers competing with bona fide buyers. But also a fair percentage of that volume that has occurred has been people who have benefited from QE and have made a lot of money because of the stock market bubble are taking that money out and they're buying vacation homes. I saw a statistic the other day that talked about how this vacation home sales are at an all-time high right now. Now that's not necessarily productive for the housing market because it's not recurring buy and sell activity, essentially. You see what I'm saying?
Yeah.
Where you're recurring buy and sell activity, most of that occurs between first-time buyers and move-up buyers, and that market is effectively frozen. And then there's another statistic. You keep hearing the National Association of Realtors whine about low inventory. Well, first of all, they really started beating the drums on low inventory the last couple months. Well, guess what? If you look at it on a seasonal basis, inventory is always very low around this time of year. In fact, for February, which is the latest month we have numbers for, I looked at the inventory number, and it's not out of whack with what the inventory number was for the last 3 years. So, but this is a fact that will probably stun most of the listeners. And this is a report that comes from RealtyTrack, so it's good numbers. And you would, RealtyTrack would have every incentive to try and sugarcoat this report, but I mean, it's ugly. 35% of all homeowners in this country still have effective negative equity in their home. Now, effective negative equity is defined as the amount of equity in your home less how much it would cost to list your home, sell it, and move into a new home.
Yeah, and here's some other statistics. I mean, only I think 40% in the United States, Americans in the United States have a full-time job, and I think like almost 40% of all millennials, Generation Xers, 20 and 30 somethings, live at home, back with their parents. So they want a full-time job. They want to move out of their house. They want a girlfriend or a boyfriend. They want a place to take someone on dates and stuff. And, they just haven't been able to find that full-time job. Maybe they have 2 or 3 part-time jobs and they're not getting any sleep and, they're working weird hours. I have a lot of friends, unfortunately, who are in that situation. But, the numbers that I see, that I look at, and I know you look at similar numbers, I don't see the real economy recovering. There were a lot of jobs created from the shale oil boom. A lot of those were very high-paying jobs. There was a multiplier effect for a while where, all these shale oil boom towns were getting high-paid wages too. to service these the oil workers' jobs. But now with the oil prices low and the hedges of the shale oil companies coming off and the bankruptcies that could ensue soon, we're seeing these enormous job cuts. I'm not seeing any evidence that there's going to be the money, the full-time job growth for people in my generation, for Generation Xers or millennials, unless you're an internet entrepreneur and, you designed $1 billion app like Snapchat or something. You're not going to be able to go out and put down a down payment to afford a new house.
Right. Just to circle back to the Realty Track data, I mean, that means, more than a third of all homeowners still are stuck in their house. They can't afford to list it and sell it and move even if they wanted to. They can't afford to list it and sell it and go rent because it would cost them money to do that. So as long as they can make their mortgage payment, they're gonna remain where they are. So that would explain a large portion of, to the extent that inventory is lower now than it might have been 3 or 4 years ago. That goes a long way to explaining what it is. Some cities it's even higher. I was shocked in Denver, which has had a pretty good economy because of energy. The number of homeowners that have effective negative equity is 40%.
Yeah, that sounds like serfdom, Dave, where you don't have any positive equity in your house. If you're just paying a debt and the debt on the mortgage on the house is worth more than the actual value of the house. But they changed the strategic default laws, right? So now people can't walk away, whereas I think in the past, around 2008, 2009, it was very easy to walk away. The strategic defaults, I guess, laws have changed.
Well, you don't walk away. You just stop paying your mortgage. There's now, I was reading an article the other day, there's some areas of the country where there's people who haven't made a mortgage payment in 5 years. And I know the average time between your first being declared in default and eventually getting foreclosed and tossed out is over 3 years now. And part of that is because of the way the legal system is set up, but it's just, the banks don't want to declare someone in default because then they have to take a hit to their earnings, and that's part of what the problem is. And part of the reason why they can afford to do that is the $2.6 trillion that the Fed has given them from QE that's sitting in their excess reserve accounts at the Fed earning interest. It gives them the liquidity to absorb cash flow losses from bad assets without declaring them bad. You see what I'm saying? Once they declare an asset to be bad, they have to take a write-off and right away.
So they overstate, they keep the value of the asset on their books overstated, and they just keep pocketing the cash flow, and they don't have to, because they can mark the value of the assets to fantasy. They don't have to mark them to market, then they don't have to take the loss.
They can absorb the loss on pools of mortgages that aren't paying because they got all the liquidity that the Fed has given them. And it's earning interest. It's earning 0.25% interest sitting in that account.
And yet all, the street.com and all these other, mainstream Wall Street websites and stuff are all saying, oh, the bank stocks are such good bargains right now. And, they don't even see any of the stuff we see.
Look, the street.com is basically the equivalent of a comic book for kindergartners. It's completely useless. If you wanna get scalped when this market turns, just do whatever the street.com recommends.
Yeah, I mean, Jim Cramer is one of the big guys behind it, but that company, it had a really much higher market cap during the technology bubble because I think it was one of the first investing websites, and then I think now it's like, I think Jim Cramer's taking more money out of the company in terms of his salary than they actually make per year, so it sounds like kind of Ponzi finance there. I don't know all the details about it.
Speaking of Cramer, this is how you know that the housing market is about ready the housing stocks are about ready to fall out of bed. Just last week, he put out strong buy recommendations on 3 home builder stocks.
I wonder if he got a free house out of the deal.
Who knows? But with his track record, those stocks are guaranteed to get crushed over the next 3 to 6 months.
Yeah, it really makes me wonder sometimes, because he promoted Bear Stearns right before it collapsed, and he's a very smart guy, but his morality, I'm not sure how objective he's being. Let's say he's
completely devoid of morals.
Okay, well let's move on to the next topic. And speaking of devoid of morals, we were discussing Amazon. Speaking of devoid of morals, we were discussing Amazon before we started recording. You think Amazon's being less than honest about their accounting. I just bought this brand new podcasting microphone from Amazon about a month ago. It's a really nice microphone, but they gave me next day shipping, which normally costs about $30 anywhere else on the planet. Wherever sometimes it's even more than that. But I got it for $5, and I was scratching my head. I was like, they have to be subsidizing this cheap shipping. They have to be losing a lot of money on this. What's your opinion of Amazon right now?
Well, let's put it this way. I don't think they're being less than above board about their accounting. I know their accounting is highly misleading to the point of that it borders on fraud. And I think that if the SEC went in there and really held them to the letter of financial statement reporting and GAAP accounting standards, I think they would be cited for many violations. And I have a very, very in-depth report on Amazon on my blog. It's called Amazon.com, and I go into depth and I explain how the accounting works, and I show exactly where they are using extremely highly misleading accounting to make their numbers look a lot better than they really are. And essentially, as we were discussing earlier, Amazon is basically a very large Ponzi scheme, maybe the largest ever, besides the U.S. government, of course. And what it is if you look at it on a cash that comes in, which would be their revenues, versus cash that goes out, which would be their expenses, as long as their revenues keep growing, they're going to have enough cash. Although the last couple years they've had to do $9 billion worth of bond issuance in order to make up for cash deficits. But as long as revenues keep growing, they can keep this Ponzi scheme alive. If we get into an economy where their revenues stall out, this thing's going to blow up.
Yeah, this doesn't look like a company, Dave. I briefly looked at the financials. I can pull them up from Yahoo Finance, so I'm not sure exactly how accurate all of Yahoo Finance's financials are. But this is a company where, they just seem to be growing for the sake of growing, where it's revenue growth no matter what at all costs. Kind of like how, the United States banks and the United States government has to try to keep on coming up with new schemes to grow credit. They don't care if the lending requirements for the United States government with subprime auto loans and all these and student loan debt and things. Amazon seems to be in that type of mindset where, they have to come up with these the new movie business or these other types of businesses that they're getting into that are just real head scratchers in order to grow revenue, but it doesn't seem that they're making money efficiently. Normally when you create a business, especially one as large as Amazon, this is not a startup that's been only around for a year or two, so they're way past the startup phase. You want to grow efficiently. You want to generate free cash flow. You want to maybe buy back shares or pay dividends, things like that. And I just don't see any of that from Amazon. It just looks like they're taking on more debt. I see a lot of red flags in their financials.
Yeah, well, I actually go into the 10Ks and 10Qs in depth, and the Yahoo financials are a very, very superficial form of financial statement presentation. They do pull it from the SEC filings, but you got to go. You can't analyze Amazon unless you really dig deeply into the footnotes, and I don't know of any Wall Street analyst that does that. But you hit the nail.
They won't reveal it publicly then, because Amazon's probably paying them investment banking fees. But I know Einhorn has talked about it, but I don't think he's shorting it, because I think he knows that Wall Street is back. The investment banks are backing Amazon on the long side to help them sell debt and shares.
It's not Wall Street; it's the hedge funds. It's a momentum play. But at any rate, you hit the nail on the head. The revenues, they have to grow their revenue base for the sake of growing revenue base, because that's how they bring in cash in order to pay out their expenses. If you look at their revenue growth rate, and it's actually stalling now. In 2005, their revenue growth rate was 22%. It hit a peak of 40% year over year in 2011. And I don't have the year-end 2014 number, but year-end 2013, it was back down to under 22%. And if you look at their operating income margin, back in 2004, it was a little over 6%, which is basically a standard operating margin for decent-sized retailers like Walmart and Target. on a trailing 12-month basis, their operating income margin was 0.1%. Now that's through the end of the third quarter of 2014, and I haven't gone through. I looked at them, but it's not in my report. I don't have the full year 2014 operating income margin, but I'm sure it's at most the same as it was on a trailing 12-month basis. And they've already forecast the potential for an operating income loss as high as $450 million for the first quarter of 2015.
Yeah, and this is a 15-year-old, approximately 15-year-old business, right? So this is not a startup anymore, so there's no excuse now. This should be a consistently profitable business. They say that they have a monopoly, but look how much Walmart and Target and some of these other stores are starting to cut into their online sales. So, the market in terms of its valuation for Amazon, I would say, is pricing in, this monopoly business where it has earnings power, but yet we don't see evidence that they have earnings power where, they have consistent profitability, they have consistent, they can increase their margins, they can generate consistently more free cash flow. We're not seeing any evidence of this, and yet the stock price goes higher and the valuation continues to go higher, and it's just very head-scratching for me. But I guess, the markets aren't irrational the majority of, they're not rational the majority of the time.
Well, remember, Amazon started out as an online book reseller, and that's when they had consistent profitability and they actually made money. And every year they add on new business lines that lose more money. They've already admitted that they lose a couple billion a year on their Prime business, because if you buy a lot of things from Amazon, it's a no-brainer to do the Prime, because for I think it's up to $99 a year now, you get free shipping and you get free video streaming. That alone is worth it if you stream a lot of videos online. Or if you, like I said, if you buy a lot of products on an annual basis from Amazon, because you're going to cover the cost of shipping within the first couple months, that $99, because you get free shipping, right?
Yeah.
And it's free 2-day shipping.
Yeah, I have a lot of friends who love it, including some value investors like my friend Vitaly Katzenelson. He writes articles saying how much he loves buying things from Amazon, but he would never buy the stock. Yeah.
Whenever I want to buy something online, the first place I check is Amazon, because if they can get it to me all in, including the cost of shipping, for less than it would cost me. For instance, I buy tennis shoes all the time. A lot of times I can buy tennis shoes from the Amazon marketplace delivered cheaper than I can buy it from like Holabird or Tennis Warehouse. So it's a no-brainer. And I know Amazon's losing money on that sale just because, you take the gross margin on the sale of the tennis shoes and then net out the cost of shipping, and they're losing money.
Yeah, and it's okay for some businesses, Dave, to have a loss leader here or there. Like at the supermarket. The supermarkets, once in a while, they'll have a loss leader, a big one on, chicken or steak or paper towels or something like that, right? But then they'll make up for it in other parts, other items they sell at their company, at their business, where they'll make it up in profits on other things. Amazon's not doing that, though, right?
That's exactly right. And that's why over the last 2 years they've had to raise $9 billion from the junk bond market in financing is because their revenue growth is slowing down. And I go into this in depth in my report. The reason why the stock is doing what it's doing is because it's a hedge fund momentum stock, and it has a high beta versus the S&P 500. So, but when the S&P rolls over, this thing's going to roll over probably 3 times the amount that the S&P rolls over.
Do you think, Dave, if the management changed at Amazon, do you think all this could be fixed and the business could be turned around and run more consistently profitable on every single item then?
I don't know. I think you'd probably have to cut this thing back so much. You'd be, basically down to your basic cottage industry online retailer. I don't know. It would be subject to the whims of the general retail industry.
So it's gone too far. Then you're saying they're too far down the line to actually fix things without maybe bankruptcy or something like that. Then.
Well, I don't know. like I said, if once their revenue growth stalls and hits a wall, which if the economy turns down, which it already is going to happen to these guys, that's where they're going to hit a wall, and that's where they're going to have to probably do some sort of restructuring that'll include a heavy operational restructuring. I mean, every time Bezos announces a new business line, the stock pops, and then he can never demonstrate that he can make money on that business. And now they just got approved by the FCC or
one of the alphabet soup government
agencies to approve the drones, FAA.
Yeah, FAA, yeah.
They just got approved to do limited testing of the drone delivery service, and someone texted me when they saw the headline, "Hey, it's duck hunting season all year round now." You know, I mean,
it's time to buy some of those drone component stocks because Amazon's going to start drastically overpaying for some of them. Then he's going to trade in stock. Then he's going to go buy. They did this with a robotics company for their warehouse manufacturer. I don't even know if the robotics company that he bought, Kiva Systems, Bezos did. Not sure if it had even $1 million of revenue, and he bought it for $800 million.
I remember that. I mean, he just does all this because it juices the stock, and he sells his stock every month, and you know, it benefits him.
Yeah, and we discussed also off recording how I think he's also pledging his stock as collateral for other, personal investments he's doing, like what Aubrey McClendon did at Chesapeake Energy before Chesapeake, experienced enormous financial problems too.
Hey, this guy is the king of the Ponzi schemes, Bezos. You know, my hat's off to him for being. He's probably the greatest snake oil salesman in the history of the world.
Okay, well, let's change topics here. If our listeners want more in-depth analysis, your research report's only $20, right, on Amazon?
It's $25 on, and you can source it off of my website, Investment Research Dynamics.
Now, it sounds like a real bargain. Normally, these research reports, if you're gonna they sell in-depth ones from investment banks for like $250, $500 or more. If you're a hedge fund manager trying to buy that stuff, and I'm sure it's probably not as good as yours.
Oh, thanks. I can guarantee mine's better than anything Wall Street puts out.
Okay, good. Well, let's talk now about gold and silver and the miners. You know, we saw Allied Nevada go bankrupt. They had a pretty good deposit that was economic at much higher gold and silver prices. I just interviewed Keith Neumeyer of First Majestic Silver. He said he's been able to cut costs approximately by 40% in the last 24 months. The miners you cover, Dave, are you seeing that they've been able to actually cut costs pretty well and tread water, or are we looking at a lot more bankruptcies in the near future from a lot of primary gold and silver miners?
Well, I actually, because we don't, in our fund, we only invest in junior exploration miners. I don't really pay much attention to the large caps. Yeah, I'm sure the large caps, the better run ones, have cut down expenses to the bone. I actually have a silver miner research report available on my website, and their mine just started producing silver in the third quarter last year, and their all-in sustainable cost of production is $12 an ounce. So they make money down to $12 an ounce. And they're sitting on a fantastic silver deposit down there that is maybe they've discovered about 20% of the total amount of silver that they'll eventually find on their properties down there. And that's just one of their areas. They also have a massive, this is in Mexico, they also have a huge gold deposit that also has a tungsten deposit on it, which apparently is more valuable than gold, silver, titanium, any of that. But at any rate, the junior miners that have enough cash to last the downturn in the price of gold are going to survive. The ones that run out of cash or are over leveraged, not that Allied was a junior miner per se, but they just had too much debt, and the cost of servicing that debt with gold at $1,200 is what caused them to hit the wall. I think they also got victimized by short sellers who capitalized on what is probably the worst environment in the mining stocks that I've seen in 14 years from a sentiment standpoint. So if you were a big hedge fund and you just wanted to take a pot shot at short selling a company into the ground, that's what happened to Allied. I think if the price of gold were more around 14 to 1,600 bucks an ounce, I think Allied probably would have been able to sell more stock, and they wouldn't have filed, because they've got an enormous deposit in Nevada. I mean, I think what they've proved already is something like 30 million ounces. It's probably one of the largest untapped deposits in the world at this point. So that's what I think happened to them. They just got victimized by an artificially manipulated low price of gold and by short sellers. I think right now, if you know how to do your due diligence, I think the junior miners that are sitting on deposits, that have cash, that have good managements, that are in lower risk political areas, and that have management that have an economic interest in the stock, those are the ones that are selling. They're on sale for 10 cents on the dollar right now, quite frankly. And you can find them out there. You just need to know how to look for them. In terms of the large caps, I mean, when the gold market finally recovers and starts to move higher, which it will eventually, the large caps are going to go up. We're going to get into an environment where a rising tide floats all boats, and the large caps are going to do well, and they may start doing well before the juniors do, because that's usually how these cycles work. The higher quote unquote quality companies, larger cap companies, tend to move first, and then the juniors will the smaller cap companies will catch up and then outperform the large caps. So I think the large caps will, I think most of those will probably survive. You might see some mergers. Obviously, there's been rumors rampant about Newmont and Barrick merging. I think both companies are just horrendously managed. But I think Newmont's in relatively stronger condition than Barrick, but I think it would be a disaster for Newmont to merge with them. I think it'd be a huge mistake. I wouldn't touch either of those stocks. I think there's some more interesting larger cap plays that I would do if you're stuck with larger caps. I actually think the stocks that are going to perform the best on an intermediate term basis are going to be sort of the emerging producers, like the silver stock I mentioned, which I have a report on that on my website. And there's another emerging producer gold company in Nevada that got the crap beat out of it from short sellers because they had some production snags, which, as you know, every company ever that starts up a mine has production snags. And their project finance, they blew some covenants on their project financing that was used to fund the transition into production, and the short sellers got wind of that and just flooded the market with short shares, and the stock took about a 50% hit in the fourth quarter, and that one's going to bounce back very quickly. In fact, I think that, assuming the price of gold stays where it is or moves higher, I think that one could be an easy double within the next 6 to 12 months.
Yeah, there's always, to add to your point there, there's always production problems at almost every mine that's brought online. I've seen very few that have been brought on time and on budget or below budget or in faster than projected time. So when you're doing that, and if you're a mining company and you're going all in, with debt to bring the mine online, you just got to hope that you have enough cash in reserve and the delays don't take that long enough time to where you have to go back to the capital markets, because then the shorts are going to destroy your stock, and the valuation, if you can raise the money, it's going to be at a really bad valuation, because in this day and age, Dave, I mean, the shorts just drastically attack the stock. I mean, for especially the resource stocks, like if there's any kind of bad news on an emerging miner producer, the stock could be down 20%, 30% in a matter of days.
Right, exactly right. Because there's part of the problem is there's no buy-side liquidity, and so anyone who wants to take pot shots at the market, by shorting the stock knows that, because the sentiment's so poor.
Well, I think I agree. The sentiment is probably even worse than 2008 from what I remember. I remembered, most people thinking that they would print an enormous amount of money in 2008, 2009 in order to get the system back going, so that gold or silver had basically bottomed there outside the mainstream, that's what was being predicted. You know, the mainstream was like, oh, the world's going to end. No one should buy any stocks. Everyone should be cash, sell everything. That's what a lot of people in the mainstream were saying. But I think the sentiment wise for gold or silver is probably worse than even 2008.
Oh, it's worse than definitely worse than 2008. It's when I first started in this sector back in 2001. It was when gold was still around 250 at one point. It was vacillating between 250 and 300, and the sentiment back then was just horrible. No one was really even looking at the sector. I mean, the Huey index was like at 40 when I got into this, and the sentiment now is worse than it was then. And I think for sentiment readings on gold, silver, and the miners, I think you have to go back to maybe the early 90s to find sentiment levels that are as low as they are now.
Could the miners actually sell shares and raise more capital back when you started than they can right now? A lot of the juniors, could they do it back then?
There were some financings going on. There was a lot of mergers started happening. Like for instance, I was invested in a stock that eventually became Silver Wheaton and Gold Wheaton. There was, we're talking about like Gold Corp. When I first started, was like a $5 or $6 stock. So there was probably more mergers than stock financings, but the sector heated up pretty quickly. So yeah, there was plenty of financings that happened in the early 2000s as the price of gold started moving higher.
From my contacts, the people I speak with in Toronto and Vancouver and other gold and silver experts besides yourself I speak to, it sounds like there's very little, if any, debt or equity available unless you're a producer like First Majestic Silver and you have a decent amount of cash flow and you're not running your mines in enormous losses. Then you can get some money, but it's not at normally good at a good valuation if you're raising stock, or at a good interest rate if you need debt. Although, from what Keith Neumeier was telling me, the investment banks are calling him every day trying to sell him debt, and he won't take that. He just did an equity raise at, I think, $6.50 because he wants to take that money and do an acquisition and buy assets for cheap. And he also just did an IPO for First Mining Finance because, like you said, the assets are selling for 10 cents on the dollar. And I think he went out and bought like 18 different mining assets, or he pieced them together. And, he just wants to buy and hold those assets and wait until valuations revert back to the mean and go much higher.
Yeah, no, that's a smart strategy, because he can raise equity at a price that's not really dilutive, and if he invests it properly, it'll be a home run.
Yeah, I think that's a really good, interesting speculative play, and their business model actually is, once they sell a few of these properties, they're going to hold on to a royalty, so they'll be generating some cash flow and rinse, recycle, repeat. So it's an interesting business model. The majority of other companies, though, in this market right now, if there's a company that's trying to bring a mine online, or they brought it online, 2 years ago, what I've seen, Dave, is almost all the gold and silver production from primary miners since 2009, it needed much higher prices than we have right now. So maybe those mines have been able to cut the fat a little bit, but in my opinion, from looking at the financials of the producers, I just see so many of these mines running at enormous losses. Despite this stimulus, this bonus here of lower oil price, I don't see it translating to profits from the miners yet. So I'm a little wary about how much more expenses at the mines these producing miners can actually cut. But I think the really prudent ones that didn't take on too much debt, that bought lower cost mines, they have cash and they are looking to buy juniors now. You're starting to see some mergers and acquisitions, but the balance sheets, the financial statements of so many of these producing miners were so god awful, and they did so many really horrible acquisitions at much higher gold and silver prices. They're out of ammo, or they're snake bitten, or the management team, if they weren't replaced already, they're they're looking over their shoulders, worrying about if they're going to be replaced in the next year or two.
Yep, no question about any of that.
Now, my last question for you, Dave, before I let you go, we were discussing GLD. Do you think GLD? We just had this email that David Jensen just sent me that England just imported over $500 million worth of physical gold from Turkey. Do you think this is starting to signal that that the bullion banks are running out of physical metal and GLD?
Absolutely. I think right now, we just had a conversation with James Turk last week, and he pointed out that currently gold is in backwardation in London, which means it costs more to buy physical gold for immediate delivery than it does to buy an LBMA future 1 month out. And ordinarily you would think that so you got basically an inverted curve for gold, meaning it's the current cost to buy it and have it in hand is more than buying it 30 days down the road. And when you have an inversion like that, typically arbitrageurs would go in and arbitrage out the spread, right? They would sell physical now and then buy a forward at a lower price, take delivery of it, and then send the physical back to the person they shorted it to. But people want delivery right now. And when you have, he actually said, like his business will buy gold in $1 to $2 million chunks. He said that the typical physical delivery is T+2 in London, and he said when he buys physical gold for immediate delivery, they tell him we can't get it to you in T+2, and he usually has to wait a week or two before it gets delivered. And that's part of the reason why you can't arb it out right now, because you don't know when you're going to get delivery of your physical. Now we're talking about 1 to 2 million ounces, or $1 to $2 million worth. If you have extremely large purchases, like if a central bank or a very wealthy individual or a big investment fund went in and wanted to buy $30 or $40 million worth of gold, they're going to have to wait a long time to get it delivered, probably longer than 30 days. And so that's why the backwardation can't be arbed out. And essentially what it tells us is that London is pretty much cleaned out of its physical gold. And I believe, as does James Turk, that includes the GLD vault. Because even though they're currently reporting 734 tons sitting in the vaults meaning the main HSBC vault plus the sub-custodian vaults, that doesn't mean that the actual physical gold is sitting in those vaults unencumbered, because most likely that gold has encumbrances on it. So in a sense, yeah, GLD is probably pretty much wiped out of actual physical gold that belongs to the trust.
Yeah, I think that's very accurate. I mean, we're just seeing, if you believe the research of Kuz Jansen and Bullion Star, and I think he does a great job with his research of the Shanghai Gold Exchange, and that's not the data that the People's Bank of China. That's not because they don't buy their gold on the Shanghai Gold Exchange. They buy their gold probably from the LBMA, but we're seeing enormous statistics of actual real demand for physical gold and silver out of India, China, Asia, the Middle East. The demand is just enormous, and the miners look like, if the prices of the gold and silver don't go back up, some of these mines could potentially shut down or be put on care and maintenance in the near future. Or, the copper prices crash too. So what I've brought up, and I haven't heard that many other analysts talk about this, is a lot of these copper deposits, primary ones with gold or silver byproducts, enormous amounts of gold and silver as byproducts, these copper mines were brought online at much higher copper prices. They were hedged for 3 years, 4 years in advance, and, they're nowhere economic at the current copper level. So what happens when those hedges come off and that copper production has to be drastically cut, or those miners go out of business, or they just put their higher cost copper mines on care and maintenance? And then, what happens to that gold and silver production then?
Yep, that's exactly right. I mean, we're definitely seeing lower production numbers overall from both gold and silver, and what you just described is part of that dynamic.
My final question, Dave, I know I said it a couple minutes ago, but my final question, yeah, you and me could talk for a while. We have fun. My final question, though, has to do with the SDR and China announcing their gold reserves increase. Do you think we're going to see China get the RMB into the SDR by the end of the year? And is that going to coordinate then with their a public announcement of an increase in their gold reserves too by the end of the year?
That's a good question. I mean, it sounds like China wants to be part of the SDR. I don't know that it. I don't know. I don't think the SDR is a viable reserve currency replacement for the dollar.
I agree. I think the SDR is just a temporary fix. I think like it's only designed to last for like 2, 3, 4 years or something before the next system is figured out. It might buy them a little time.
I honestly, the more I look into this, I don't really know what the reset's going to look like. I mean, there's definitely going to be a reset that replaces the dollar, I mean, I know China has announced that they're going to. Aren't they supposed to release their updated reserves like in September or something?
I don't think they've issued an official press release saying that, but there's speculation from a number of people in the gold community saying that. There is, Dave, however, a secret IMF meeting and World Bank meeting going on starting this Friday here in Washington D.C. But I don't think I can get. I don't think I can get in there. I'm sure we would get better answers to some of our questions about this there. Yeah, I think there's a fight going on about what the next system is going to look like. I think the U.S. obviously wants to maintain the status quo, and I think China has like probably multiple contingency plans with Russia and some of the other G20 countries on what the next system is going to look like.
Yeah, that meeting actually, gold is part of the discussion agenda. Honestly, I don't really know what China's plans are, how they're going to play this out. What I would suggest, though, is that I don't see any reason for them to tell us the truth about what their real gold holdings are. Unless their plan is to roll out a full-scale gold-backed currency that they want to force onto the world as a reserve currency. And I don't know that they necessarily want to have a reserve currency. I don't know why the world needs a reserve currency. I don't think you do, because all a reserve currency does is give the issuer, control over the rest of the world. That's why the U.S. had become the world's basically single superpower once Russia had collapsed. So, and it basically gives the issuer of the currency huge advantages over everyone else, and I hope the world is done with that. But who knows how this thing is going to play out? I used to think I had a pretty good idea of how it was going to play out. Now I have no idea.
Well, I know I've told you this, and we've discussed this, and I know you listen to some of our other interviews. They're doing a lot of currency swaps and other stuff behind the scenes, covertly, just to keep the system from collapsing tomorrow or the next day or a week or a month down the line. So, but I think everyone kind of realizes that this is going to run out of gas. They're just fighting over, I guess, a power struggle over the next system. But I completely agree with you that it's definitely not in China's best interest to be honest with how much gold they have. So if they have 20,000 tons of gold or 30,000 tons, as we've heard some people say that the Chinese government already has that, not counting how much private gold the Chinese citizens have, it wouldn't be in their best interest to announce that they actually have that much gold. It would be smarter for them to say, they only have 3,000, 4,000, 5,000 tons of gold, and then keep accumulating it, at this artificially suppressed paper price as cheaply as possible. Why not go buy some miners too? Finance these larger Chinese mining companies. Why not have the Chinese banks then finance and go buy some of these good gold deposits out there that are cheap now too? Buy the gold and silver as cheaply as possible and keep accumulating it as long as you can at such a suppressed price, and before we have shortages.
Yeah, as a matter of fact, I'm aware of a junior royalty miner who is in active negotiations with a Chinese company to purchase one of this company's assets. It's an enormous copper mine in Eastern Europe, and this stock is going to be a home run if this deal happens. So I'm going to put a report out on this company at some point in the next couple of weeks. So hopefully a deal doesn't get announced by then. I don't think it will, though.
That sounds interesting. I'm actually surprised, Dave, that China hasn't been more aggressive going and buying like oil assets now at these valuations, while there's blood on the streets and potential bankruptcies, and the same thing for gold or silver miners. I'm actually really surprised they haven't pulled the trigger on it, given how much paper they have. I'm surprised that the Chinese government hasn't ordered the state-run Chinese banks to go and finance their miners to go do these types of deals yet.
Well, I think my understanding is they're still more, they're still just, they buy individual properties and land, and my understanding is they've been extremely active in Africa, and when they do deals over there, you don't read about it. So, and they also tend to culturally move more slowly than we in the United States expect everyone to move.
Yeah, that's a good point. Except in 2008 and 2009, when the oil price crashed, it was at 150 and then it crashed to 30 something. China was acted very quickly and was doing massive deals for long-term oil supply contracts. So that's like one of the few counterexamples of China moving very quickly in like the resource environment. So normally they don't act that quickly, but they saw an enormous bargain how it wasn't sustainable.
Well, I think China has probably snapped up most of the low-hanging fruit at this point.
Yeah, especially for physical metal, for physical gold. Yeah, I would definitely agree. I'm actually surprised they haven't started buying as much silver, but maybe they have. Maybe the SLC.
We have no idea what they're doing with silver. we do know that the Shanghai Futures Exchange saw its silver stock decline 90% between 2013 and the end of 2014. So,
well, Keith Neumeyer said last year in an interview that there was a very large factory in China. He had heard that they had trouble sourcing physical silver for 2 or 3 weeks for their electronics manufacturing, and they had to shut down. So I guess there is developing shortages, but they're not permanent long-term ones yet. So I guess there's just some bottlenecks so far. But if a lot of these primary silver miners go bankrupt, or copper miners start shutting down their mines or go bankrupt with a lot of silver byproduct or gold byproduct, that's going to put a complete floor into these markets, and then we're going to go a lot higher, I think.
Yep, I agree.
Okay, great. Well, please tell our listeners more about your new Shadow of Truth podcast and your website, Investment Research Dynamics, and your gold fund.
Sure. So, the Shadow of Truth is the name of the YouTube channel, and it's a joint production venture with a friend and colleague, Rory Hall of the Daily Coin. And our concept is to interview 1 to 2 people a week, and we try to keep it focused on news events that have occurred in the last 48 to 72 hours. And we also, have them talk about, the general topics about gold and general economic issues. And we also try to keep the interview, if we can, under 30 minutes, which is kind of hard. But we've had guys like Dr. Paul Craig Roberts, Jim Willey, James Turk. We're interviewing Bix Weir this Tuesday. So I've got that going on. And then my blog is Investment Research Dynamics, which is you can access at investmentresearchdynamics.com. And I try to post current events and shine the spotlight of truth about what's really going on. And I post usually at least 2 to 3 times a day if I can and if I have time. And then I also offer research reports off my blog. Right now it's primarily housing stock ideas and junior gold miner ideas, and then the Amazon report, of course. And at some point I'm going to expand it. As it looks like the S&P is going to roll over, I'll come up with a lot more short sell ideas, because I think there's going to be a lot of money to be made on the short side if people are prepared for it when it happens. And then I also co-manage a small precious metals and mining stock fund. We buy physical gold and silver that we keep in an independent private depository. And we also have a portfolio of junior mining stocks. And one of the features of our fund is that when investors redeem their investment, they have the option of redeeming their pro rata share in gold and silver, and we'll actually send them physical gold and silver from the vault. And so that's it in a nutshell.
Great. Well, I enjoy speaking with you every couple months, and I look forward to having you back on again in another couple months.
Likewise, Jason. Thanks for having me, and I look forward to doing it again.